Good morning, everyone. Financing gap in emerging markets has been always high, and the COVID-19 crisis, combined with the climate change, will only exacerbate this gap, notably in the areas of infrastructure, education, and innovation. Advanced economies have been contributing to finance projects in emerging markets for decades through loans and grants. Today, nevertheless, everyone would agree that public finance sources, limited to less than 10% of the estimated financing needs, are and will remain insufficient, and therefore the mobilization of private sector is key to filling the gap. But why private sector don't see emerging markets as an alternative source of investment? Hence, additional return, in particular in a negative interest rate environment. Well, operating in those countries is costly, and markets are not sufficiently regulated. But the key driver for not investing in emerging markets lies with the perception that investing in those countries attracts more risk than in developed markets. This is where GEMS, as a unique consortium of multilateral development bank, international finance institutions, and national agencies, can demonstrate to private sectors that investing in emerging markets is not more risky. Based on a credit experience of more than 30 years, GEMS and its partners have accumulated enough data to show that doing business in emerging markets is attractive. Thanks to this very innovative partnership among public institutions, we believe GEMS will be a game changer for private investors going forward. Thank you for attention. I'm ready to take your questions. I see a question in relation to how GEMS compare to other source of data. I'd like to comment on this, as GEMS is quite a unique database because there's no database in the world that can compare for emerging markets very specific credit experience in those markets. Why is that? Because most of the database available are combined by rating agencies which collect data across the globe, depending on the credit quality of the assets. And this is done on a global basis without specific focus on emerging markets. That's why this makes GEMS quite unique as a database for emerging markets countries. The next question is, why did you come up with the idea of creating a common database? Well, this has been a pilot project that has been promoted by actually two main institutions historically. One is the EIB, European Investment Bank, and the other one was IFC of the World Bank. This was initiated about 10 years ago as a pilot. The idea was to be able to combine data of the two institutions in order to demonstrate the, let's say, how complementary these two institutions would be by bringing together their own credit experience. From there, the idea had been to extend this consortium to other members. And today, progressively, this consortium has increased to about 24, 25 institutions so in the world, which means that today this represents a large portion of the institutions present in emerging markets, from again, institutions present in America and South America in particular, in Africa, in Asia, in Eastern European countries, and elsewhere. So it's quite now a large representation of these institutions across the globe. As you can see, I mean, from this slide in front of you, we have now quite a significant representation of the database, which means that we have about now 9,000 counterparts represented in this database, which is quite granular enough to represent the credit experience that we have, again, in the different regions of the world, in different sectors as well, showing quite a large spectrum of credit and return experience from this multilateral development bank, IFIs, or national agencies. Next question is, what were the main challenges in creating this common database? Well, this is a business by itself. I mean, these institutions are banks or agencies, and they have been collecting in their history a lot of data, obviously for regulatory reasons. But merging data across these institutions has been quite indeed a challenge because initially the systems were not obviously align. Also, the methodology that we've been using at the time was not fully aligned, also referring to the same benchmark or concept. That's why a lot of work actually has been done over the years in order to indeed align as much as possible the methodologies by using external references. Notably, we used a lot rating agencies, benchmarking and methodologies in order to help us defining the best uniform set of data to be collected and therefore merged. Obviously, this is still a challenge today. There's a lot of detailed information that needs to be brought together and aligned. So the devil is always in the detail. But we can say today that a lot of progress after more than 10 years has been reached. And also the quality of the data at aggregate level is seen as sufficiently robust to be shared with the external world. This has been the case already by sharing to professionals the output of this database, again at aggregate level. And it is in our intention in the steering committee of this consortium, GEMS consortium, to actually make public the data at sufficiently aggregate level. So this is something that will come now rather soon, hopefully before the end of the year. This will certainly bring a lot of added value into the market, as there's a lot of expectation from, notably from the private sector, a lot of counterparts, being banks, insurance companies, or pension funds, who approach us, the GEMS, in order to get the data that have been collected so far. It will be, I mean, for us, we think quite a game changer also for private sector participants, because they were expecting, I mean, this data to be able to be used by them in order to compare them with their internal source of information. This, again, I'd like to put this into the wider context of bringing to the private sector some clear elements of analysis and data showing how risky is doing business in emerging markets. I don't see any other questions coming from the audience. So what I would suggest is maybe to wait for another minute, and I would then stop this presentation and interaction with you. Well, I think I can stop here. Yes, now I see another question, coming from the room, which ask me, in order for GEMS to be comparable with other official rating scales, PDs in particular, probability of default, should be made available publicly and should be accessible for free. This is, as I was saying before, this is indeed the intention. The intention is to go public with data, so not only probability of default, but also recovery rates. So this will come now public and for free. As I was saying before, it will be on an aggregate basis, so not at the granular level, but this is something that will come now soon, and it will facilitate the comparison with other source of information, specifically produced by rating agencies, but also this will help us to fix a benchmark, a reference point to compare with internal experience from the different investors. So I think this will bring a lot of added value indeed to the market. So on that basis, I would like to thank you very much for your attention, and I wish you a very interesting and pleasant day. Thank you very much. Bye.